Hey everyone, and thanks for jumping back into the Cryptoverse. Today, we're going to talk about Bitcoin, and we're going to be discussing various entry and exit strategies. If you guys like the content, make sure you subscribe to the channel, give the video a thumbs up, and also check out the sale on Into the Cryptoverse Premium at intothecryptoverse.com. Link for that is in the description below. Let's go ahead and jump in. So in this video, what I want to do is just go through various entry strategies and exit strategies. I want to try to discuss various strategies based on the risk tolerance of various types of people. Someone who's younger, who wants to be more aggressive, is obviously going to take on more risk than someone who is maybe nearing retirement, who wants to preserve the money, the wealth that they've created over the years. Okay? So it's always important to remember that as we talk about various strategies, what is right for you could be different than what is right for someone else, right? You might not want to take profits at a certain risk level, whereas someone else maybe does. And just because they do that doesn't mean that it's the wrong decision. Maybe it's the wrong decision for you, but it doesn't necessarily mean it's the wrong decision for them. It's all about managing your risk. I mean, at the end of the day, that's what investing is about. It's not about predicting exactly where the market's going to go tomorrow. It's all about managing your risk and making sure that you're comfortable experiencing the volatility of the assets that you're willing to have in your portfolio. Now, again, I mentioned that we are having the sale on Into the Cryptoverse Premium, where you can access these types of tools. But the DCA simulation tool, in my opinion, I think everyone should have, right? Whether you're a member of Into the Cryptoverse or not. And so in order to get access to this tool, all you have to do is provide your email address, right? And you can access it. So again, on the website, there's the free plan, and you can access this DCA strategy tool just on the free plan. So I just want to be clear about that. So again, we're going to talk about entry strategies and exit strategies and how you can use those to navigate the Cryptoverse. So we had a video that I put out a couple of days ago on the risk levels for Bitcoin. And as I've said, and I don't tend to provide too much info as to what I'm doing on the public YouTube channel. And I hope people can appreciate why. It's not that I'm trying to hide anything. It's just that, I don't necessarily like advertising exactly every single move that I'm doing to the world. And so I don't generally talk about every move that I make. But sometimes I think it's worthwhile to just remind people that my strategy, and it has been like this for a while, is I pick a risk level. Below that risk level, I DCA into the market. And then somewhere above that risk level and another risk level, I don't do anything. And then above that risk level, I start to sell. Okay, so for instance, remember, these risk levels are the prices that correspond to these risk levels. They're dynamic, right? So like today, 0.4 risk corresponds to 25K. But a year from now, 0.4 risk could correspond to a completely different price, right? So like you can't just know in a year that 0.4 risk is going to be 25K. It could be, but it could also be a very different number at that time. So for me, this cycle, my strategy has been anytime we are below 0.4 risk, I'm comfortable getting into the market. When we're above 0.4 risk, I don't do anything when it just goes directly above 0.4. Last cycle, I bought Bitcoin up to 0.5 risk. But last cycle, I was willing to take on more risk than I am this cycle. Because as the cycles go on, I think that people just sort of opt to take on less and less risk because they're trying to preserve what they got last cycle, or they made some mistakes last cycle and they're trying to be a little bit more conservative in the next cycle so that they don't make the same mistakes as the prior cycle. So last cycle, I DCA'd Bitcoin up to 0.5 risk at the current prices today. That would correspond to 33K. But this cycle, I DCA up to 0.4 risk, and currently that corresponds to 25K. But as the weeks go on, that number could change. Now, what I do is between 0.4 and 0.6 risk, I don't do anything. I just sit on my hands. I say, all right, that's nice. All right, Bitcoin went up, Bitcoin went down, whatever. It doesn't change anything for me. It's just, it's just interesting to watch the market. But above 0.6 risk, that's where I get interested in taking some profits. And we'll talk about a little bit more about that later on in the video. And I mentioned in the last video that the way that you can handle that is like when the risk comes all the way up here, you can always set limit orders, like limit orders where or stop limit orders, basically, where if the price goes down to a certain level, you can essentially take some profits just so you're not watching the price drop 30% or something and you didn't take any profits, right? So that's what I do, right? So when it comes up, and I mentioned that I had a limit order set, the stop limit order set in the last when we did that risk level video, that's how I do it. But that doesn't have to be how you do it. Before we talk too much about that side of things, I want to remind you that the DCA tool is a good way to better understand how Bitcoin compares to the altcoin market. A lot of altcoins are up a lot over the last couple of weeks. But let's suppose you started DCAing Bitcoin, Ethereum, ADA, DOT, and Matic starting January 1st of 2020 through today, or through December 1st. You'll see, in fact, that a DCA strategy for those 5 coins, your Bitcoin would be up 62% from your cost basis. You would have invested $10,000. It would currently be worth 16 grand. For ADA, it would be up about 35%. For ETH, up about 27%, Matic up about 11%, and DOT up around 10%. You might say, well, how could ADA be above ETH? The reason that a DCA strategy for ADA from back then is outperforming ETH is because ADA went down a lot further than ETH. And so from those lows, right, like if you had DCA'd ADA from those lows, then your cost basis would be a lot lower, whereas Ethereum never saw that same type of drop, at least not yet, okay? So this really goes to show why I've spent so much time over the last couple of years talking about Bitcoin dominance. It's because so many of these altcoins underperform a DCA Bitcoin strategy for so long, and typically it only durably starts to change until we get to looser monetary policy, which tends to come in the halving year or the election year. So just to focus on Bitcoin though, had you DCA'd $100 a week for the last couple of years or so, 10,000 invested, currently worth about 16 grand. It's not bad, right? This is a DCA equal amount strategy. You can also do a dynamic DCA strategy where you say, I'm going to invest a certain amount and I want to know, based on the risk level, how much I'm going to put in. So that way you treat it like, all right, well, and let's say you want to DCA like me up to the 0.4 risk level, then that means if you had treated your X value as 100 starting in 2022, and then you increase that if the risk levels went down, and you decrease that as the risk levels went up, you would have put in $11,800. So about $2,000 more than if you were doing the DCA equal amount strategy. You would have put in a little bit more, right? And you would have only bought 60 of the 102 weeks, which is a lot different, right? I mean, the DCA equal amount, you're buying every week for 100 weeks, you put in $10,000. The dynamic DCA, based on the risk levels, only up to 0.4 risk, you put in 11.8, which is a little bit more, but you only bought 60 of 102 weeks. What's fascinating is the DCA equal amount, you're up 62.8%. But the dynamic DCA, which is based on the risk levels, you'd be up 93%. Yes, you would have put in more, but that's irrelevant, right? It's all about the percent up that it would be. And we can change the X to something that would be closer to the 10,000, just so we're kind of comparing the same exact thing. Let's just say, if your X were 85, then you would have put in about 10,000. It would currently be worth about 19,000. Whereas a DCA equal amount, you've put in, and if you put in 100 per week, you put in about 10,000, it'd be worth about 16,000. The dynamic DCA in, based on the risk levels, is based on this idea that in the lowest risk bands, you put in like 5x. In the next one, you would put in 4x. And this one, you put in 3x, 2x, x, and so on and so forth. The way to visualize that, as I've said previously, is to look at the risk levels like this. So like if it goes down here, if your X is say $100, then if it's all the way down here, that means you could be putting in 300. And then here you're perhaps putting in 200. And then here you're putting in 100. And then above here, you're not putting in anything. And then in here, you know, and then at some point you figure out where you want to start to take profits, right? That's the way that I do it. But you could do it a completely different way. It just depends on how you want to navigate the DCA strategy. And to also be aware that you can have pretty big drops like the one we're getting today. And gains can be wiped out in an instant. And the reason for sometimes taking profits and setting those limit orders as we get into the higher risk bands is because of days like today. That doesn't mean that the price can't go back up. I mean, a lot of times you can get a sell-off and the price can go up after that, but it is a way to reduce risk if it ends up being a larger sell-off, right? And I mentioned that when you look at the risk levels here, I mentioned previously that if we isolate just the 0.6 and higher, that's what it looks like. And here you can see we had gone into the 0.6 risk band. It's impossible to know. Like, it's impossible to know if it's going to run all the way up to much higher risk levels, like in 2021 and 2017 and 2013 and 2011, or if it'll just sort of top out like it did in 2019 at around 0.6 to 0.7 risk. It's impossible to know ahead of time. You know, I can't know it. You can't know it. Who knows? And it could seem like it's doing one thing and then start to turn back around and do the completely opposite thing. And because we admit, right, if we admit that we don't know what can possibly happen in the short term, then having an exit strategy can make sense. And the way the exit strategy stuff works is you essentially, you pick out a risk level to start selling at, whether it's 0.5 or 0.6 or 0.7 or 0.8 or 0.9 or 1. You can then say, all right, I think the projected peak of Bitcoin is going to be whatever, right? Let's just say 50 grand. I don't know. And then, you know, if it gets up to a certain risk level, then you might take some profits. Now, if you want to be conservative, that means you start selling above 0.5 risk. If you want to be moderate, it means you don't start selling until above 0.6 risk. If you want to be aggressive, above 0.7, the hodler, above 0.8, YOLO, above 0.9, and then the Sea of Tranquility is the guy that can time the top perfectly. The guy that knows exactly where the peak's going to come, and they're going to be the person that creates the top. That person is the person that follows the Sea of Tranquility. But unfortunately for me, I'm not smart enough to know where the top is, and so I don't follow that approach. I also don't follow the YOLO approach or the hodler approach or the aggressive approach. I also don't follow the conservative approach. I'm more in the moderate camp, where in the 0.6 risk level, 0.6 to 0.7, it's okay for me to take some profits, right? Which is, you know, where we've been. But I also don't necessarily want to sell everything in case it continues to go up. In 2019, what happened was that we went to the 0.6 to 0.7 risk band, and I sold a little bit. And I wasn't even using this risk metric back then. I was using a slightly different one. I think I created this one in late 2019, but I was using a different risk metric. And we went to the 0.6 to 0.7 risk band. I sold a little bit. And I remember thinking, you know, it would have been nice if I'd sold all of it or more than I did, because we dropped all the way back down to near the prior low. And I was kind of mad at myself for a little while. And then I just remember thinking, like, there's no way I could have known, right? There's no way I could have known that it was going to top out at 14K. Hell, most of the people were not even predicting it was going to get anywhere near 14K in 2019. You know, a lot of people were saying, oh, 6K is where it'll top out, because that's where, you know, there's this support level turned resistance. Therefore, there's no way it's going to get to 14K. So the fact that I even had the ability to sell some at like 12K or 13, because I didn't time the top either. I think I got some out at like 12 or 13K back then. It was nice, and I felt good about myself for taking some profits, but I also kept beating myself up for like, why didn't I just sell everything? You know, like if I just sold everything and then bought it back when it dropped 70%, I would have made so much more. You know, I would have preserved the USD valuation of my portfolio and so on and so forth. But I didn't know. Like, I didn't know how high it was going to go. And so I sold a little bit, and then we came back down to lower risk levels, and I bought back in. And then we had the run all the way up to the 0.9 to 1 risk band. right? So then today, it's a similar type of situation, right? Like you know, in the 0.6 to 0.7 risk band again, we've been in there for the last couple of weeks, and we're actually just below it right now. We're at 0.579. And the question is, you know, is it like 2019? Or is it like 2021? Or is it like 2017 or 2013 or 2011? No one knows. Everyone's got a reason why they think they know, but no one knows, right? No one knows how high it will go. And so if we admit to ourselves that we can't possibly know, but we want to manage our risk no matter what happens, then the way to navigate that, in my opinion, is to have an exit strategy and to say, all right, well, when it gets above X risk level, I'll sell a small amount. If it gets above a higher risk level, I'll sell even more. And so there's various strategies, right? There's constant, meaning you're selling the same amount of Bitcoin at each risk level. The reason why here you get 2.8K versus here you get 3.6 is because, you know, it's sort of assuming that the price of Bitcoin is higher, right? Like at 0.5 risk, the price of Bitcoin is lower. So if you're selling like, you know, let's say 0.2 Bitcoin here versus 0.2 Bitcoin here, you're going to get a higher price. That's why you're getting more. So by the end of it, if it went all the way up to 50K and you followed this selling plan, you have sold out all your Bitcoin. You would have made 32 grand. What's interesting to me though is I follow the linear strategy, and what's really interesting is look at this. The moderate strategy, if you follow that, it ends up being about 40K. The funny thing is the person who's a genius, who knows exactly where the top is and sells identically everything at the top, they only made 20% more, theoretically, right? The person over here who took some profits, maybe they slept easier because they're like, all right, well, I took something off the table. So if the market capitulates and we get, you know, a big drop like we've seen in the past, it was nice to have some taken off the table in case something like that happens. But to sell everything, if it keeps going up, that's where you have to be careful. In early 2021, I sold most of my Bitcoin in the first peak, okay? 87% of my Bitcoin in the first peak, 87%. And then after that, what happened was, so if we look at this, this is above 0.8. This is 0.8 to 1 risk. So I sold most of my Bitcoin in this first peak. And then, because back then I was DCing below 0.5 risk, we went to below 0.5 risk, right? You can see right here. We went up here, so I sold. And then we came back down here, and I started to buy back in. And then we came back up, and I was thinking that we would go even higher. But we didn't, right? We didn't. We only went back up to that 0.5, 0.6 wristband or so. So the point is, you know, anyone who bought over here, if they just stuck with that strategy, they would have sold a little bit at above 0.5 risk, but then you can see what happened next. So the point of these videos are to say, look, you can have an entry strategy based on a DCA equal amount no matter what. It could be a lump sum strategy. It could be a dynamic DCA strategy where you base it on risk levels or something. It doesn't have to be the risk levels. I don't care what it is. Maybe you want to base it on, I don't know, the phases of the moon or something. I have no idea, but don't really. But the point is having a strategy is what people should have, right? If you have a strategy, you stick to it, then it helps you sleep better at night. I mean, think about how many people have just spent so much time worrying about the price, you know, but the thing that I go back to is like, you have to enjoy your life, right? You have to live life. There's so much more to life than just worrying about what the price of Bitcoin is every single day. So just having a strategy and being okay no matter what happens with the price is the way to go, right? So why I say that is, let's say you're someone that buys below 0.4 risk, like me. Then you don't fear lower prices. You just say, all right, if it goes down to lower prices, then I'll buy. If it goes higher to higher prices, then I'll sell some of the stuff I already bought at lower prices. That's the idea. So instead of worrying every single week, is Bitcoin going to go up 10 grand or go down 10 grand? you don't care, because whatever it does, you already know what you're going to do ahead of time, right? You say, if it goes up, I'm going to sell some. If it goes down, I'm going to buy some. But not worry so much about what it's going to do, but react to what it does do based on your own strategy. And you can apply the same stuff to other assets. Like if you want to look at it for Ethereum, you can do the same type of thing, right? You could say, all right, well, if you DCA'd $100 into ETH for the last couple of years, you put in 10 grand, and now it's worth about just less than 13 grand. I mean, that's great and all, but Bitcoin was less risky, and it would be now worth over 16 grand. So that's the point. And you can also change the day of the week as well. You can look at Sunday or Wednesday and see kind of how that would affect things. Like how would it have affected things had you bought on different days? I think that can be useful to look at as well. But that's essentially where we are in terms of trying to understand like ways that you can get into the market, ways that you can get out of the market. Again, you can get access to the DCA equal amount tool free. Just go to the website and you just provide your email address. The risk level stuff is on the paid tiers, but I mean, look, you don't need access to that to successfully navigate crypto, right? You don't. You just need to come up with a plan and stick to it no matter what. And then here the exit strategies are, and we could show it in terms of percentages. It might be a little bit more clear. So like, let's say you're following a linear selling strategy and the moderate approach, which is what I do. So it means selling about 7% in the 0.6 to 0.7 risk band, then 13% at 0.7 to 0.8, 20%, 0.8 to 0.9, 27%, 0.9 to 1, and so on and so forth, right? So like this is off by 1, right? So it's 0.5 to 0.6, 0.6 to 0.7, 0.7 to 0.8, 0.8 to 0.9, and then 0.9 to 1, meaning if it makes it to the highest risk level, then you're selling the last, your remaining Bitcoin, which would have represented 33% of your original stack. But you can see the way this works is that at a low risk level, you're only taking a small amount off the table. And then as the risk levels go up, you increase it. And if you want to be like more aggressive, then you can say you don't even start selling until it gets to 0.8 risk. The thing about this is like, some people might say, well, what if Bitcoin, what if the person who is DCing out of the market, let's just say they don't sell until 0.9 risk? What happens if you get a 2019 scenario where it goes up to 0.6 to 0.7 risk and then it just collapses back down? Do you think they care? Probably not, right? Probably not. That's the point. If someone has the conviction in Bitcoin that it's going to go up eventually, even if it goes down first, if they're following this strategy, they probably don't care, right? Like, there's a lot of people out there that if Bitcoin were to drop 50%, it would not change their conviction at all, right? At all. Now, there's also a lot of people out there that would say, well, if I know Bitcoin's going to drop 50%, it'd be nice to take profits before that happens. But when you look back, I mean, the people that sold some in 2019, they preserved some profits, right? They preserved something. The people that didn't, it was painful for a while, but eventually, do you think they really cared? Do you think they cared when Bitcoin was 60K, that they didn't take some profits at 13K? Probably not, right? Like, it all depends on what your risk tolerance is. For some people, they want to take on more risk. Other people, they want to take on less risk. So it all depends on how much risk you want to take on, and it has nothing to do with other people. I feel like everyone loves dunking on everyone else. Like, like sometimes I'll see people that bought at 15K that publicly did it, and they publicly sold some at like 35K or 40K or wherever, and then the price goes up to 45K, and then they get dunked on for selling at 40, but it's like, they still made money, And I mean, at the end of the day, that's why we're here, right? I mean, we're investors. I know some people are in it for the tech, but I would argue that the people that claim they're in it for the tech have also spent all year long nonstop talking about spot ETFs, and I struggle to understand how spot ETFs is representative of someone who's in it for the tech. So I think the reality is that 99.9% of people are not in it for the tech, and they're here to make money. And if the chart of Bitcoin were the inverse of this and it were just going down over the decade, do you really think people would be in it for the tech at that point? Probably not, right? People are here to make money, right? Investors are here to turn a profit, and it's the good technology that we believe will allow asset prices to go higher. But if Bitcoin only ever trended down, I imagine the cryptoverse would be a desolate place. So look, I'm here to be as an investor, right? We see the volatility, we want to take advantage of that volatility. That's why I'm here, and I stick to the risk levels no matter what, right? I'm not that great at timing the exact top or timing the exact bottom. What I do is I just say, hey, where is the risk level for Bitcoin? Oh, it's 0.4 or less? Then I'll buy in. Between 0.4 to 0.6, I'm a spectator. Above 0.6, then I start to scale out some slowly at first and only accelerate that if and when we go to the higher risk levels. So the biggest question I guess everyone wants to know today is, will we go to the higher risk levels with, the SPY ETF stuff and the halving? And look, I don't know. I really don't. Historically, we've never gone to new highs before the halving, right? Could this time be different? Anything's possible, but historically it has not happened. And if it were to happen, this would be the first time. So, I've previously said, like, it's not the most likely outcome, but I'm not going to say that it can't happen. We all have theories about what's going to happen, and some of them pan out, some of them don't. And so who am I to say that it can't happen? But I will say that it has never happened, and it's also never happened when net liquidity is not, pushing higher, right? We're still in a phase right now. If you're not familiar with what I'm talking about, like we're still in a phase right now. If I were to show you the net liquidity, and I were to overlay this up here, let me switch this to a log. Right. So normally when Bitcoin is making new highs, net liquidity is also making new highs, right? So like from here up to here. In 2019, we did not make a new high, right? But one of the reasons for that is because net liquidity had not made new highs, right? You can see that in 2019, when Bitcoin topped out right here, net liquidity was all the way down here. It was not at a new high. And it wasn't until net liquidity made new highs that then Bitcoin went on a bull run to actually make new highs itself. If you go back to the cycle before that, you can see that here, when Bitcoin made new highs, net liquidity was also making new highs. And then today, I look at it, and we have net liquidity back in 2021 was all the way up here. But today, it's all the way down here, right? So to me, it still looks more similar to 2019 in terms of the net liquidity being all the way down here, right? Then putting in new highs, which normally when it's putting in new highs, that leads to Bitcoin going to new highs. When net liquidity goes to new highs, then Bitcoin typically follows. But this time, like in 2019, net liquidity was not going to new highs, and then Bitcoin topped out before it got to a new high. It did not make a new high until net liquidity made new highs. The problem that we have is that net liquidity is likely not making new highs until the Fed pivots, right? Until we get back to QE. And the problem with that is that we're likely not going back to QE until the economy starts to slow down, right? So it's like a lot of people are saying, well, like, the Fed cutting rates will be super bullish. And I mean, in general, yes, going back to looser monetary policy would be a good thing for crypto. But then the counterpoint is that, like, what's going to make them go back to looser monetary policy, right? Like, are they going to cut 200 basis points and start printing again out of the goodness of their heart because they want to support crypto valuations? Or would they start doing that if the economy slowed down, right? So that's kind of like the catch. Like, people want interest rates to go lower, and for that to help boost the valuations of risk assets like cryptocurrencies. But then how do you get that without inflation coming back down? Like, how do you get that without the economy slowing down and the Fed feeling like they need to do something to prop the economy back up? So good chance we're going to see them, start to become a little bit looser with their outlook in 2024. But I also have to imagine that it would come on the back of a slowing economy if it's going to play out like that. Again, guys, there's no guarantee that it has to follow 2019. I'm just simply pointing out that previously, you're looking at new highs before in net liquidity, often before Bitcoin itself goes to new highs. Oftentimes. At least out of the data points that we have, but admittedly, it's not a lot of data points. Okay? Could this time be different? Anything's possible. But guess what? You don't have to spend too much time worrying about it, because if you have a plan, you can stick with that no matter what, right? You say below a certain risk level, I buy. Above a certain risk level, I sell. And anything in between, I'm a spectator, and I don't hope for price to go in one direction or the other. I just say, if it goes down, I do this. If it goes up, I do that. And I don't really think it needs to be more complicated than that. So, and as far as Bitcoin, it has seen a pretty big pullback here. I mentioned yesterday that the first area, yes, 40K, I imagine, is an area that the bulls will try to hold as support. If that falls, then you have the 8-week SMA, which we've mentioned, which is around just above 38K. You also, by the way, you have the 100-week moving average and the bull market support band, which are much lower, right? So like the 20-week SMA is all the way down at 31K. 21-week EMA is at 33.5. The 100-week is at 27, 28K. So it's a lot lower. The only reason I mentioned the 100-week SMA as a possibility is that's actually where we fell in 2019. After Bitcoin came up here and put in this top, it then fell back to the 100-week SMA, and it fell to the 100-week SMA here in October 2019, but also hit it in the first part of the halving year. So in late December, early January of the halving year of 2020 is when we were at the 100-week moving average, which is kind of interesting, because if you overlay, and we've done this a few times, right? But if you overlay interest rates here, sorry, let me add this to a, actually I need to go up here. So we're gonna add US interest rates. So if you do that, right, you can see like Bitcoin topped out just before the Fed started to cut rates, right? So the Fed started to cut here, and Bitcoin had just topped out before the Fed started to cut. So you might see something like that happen again, right? Where like Bitcoin, it kind of follows a similar path. And I wouldn't be that surprised to see something like that happen, where, it tops out, and it's possible it already has, but if it hasn't, then it tops out before rate cuts occur, and then maybe it bottoms out around the last rate cut or somewhere in between. And again, if you overlay that 100-week moving average, you can see that it actually pulled back to the 100-week SMA during rate cuts. And again, I don't know when they're going to start cutting, but if you go look at the probabilities over here, which, by the way, these things change all the time, but let me reload this. If you look at probabilities, they're not saying it. The market doesn't think they're going to cut till May. I don't know if it's going to take that long, but we'll see. But anyways, hopefully you guys enjoyed this video. Just remember, have a plan, stick with it no matter what. Into the Cryptoverse is on that we are running the sale right now. Links in the description below. But as I said before, if you just want access to the DCA simulation tool for equal amounts, and you can look at a lot of different cryptocurrencies, and we got a lot on here, you don't need a paid plan. You can just get the free plan for that. Links in the description below. Make sure you guys check it out. Thank you guys for tuning in. Subscribe, give the video a thumbs up. I'll see you guys next time. Bye.